Hello, everybody, and welcome back to another episode of the Rogue Agent Answers. My name is the Rogue Agent. Some people call me David Lewis, and every week I answer one of the many life insurance related questions that I've received from clients, from email subscribers on the daily email list, questions floated to me from across the interwebs, in the comments sections, which I know you're not supposed to read, or just interactions that I've had with people in real life over the past 20 years, which is a long time. And some of these questions I just scribbled down on scrap pieces of paper. Some of these are stuff I've written down on my phone. Some of it is on Post-it notes scattered all over the office. And every week I answer one of those questions. So if you'd like to ask your question, drop them in the comments section or join my email list for more life insurance tips and advice at monogenics.com. monegenics.com. And now for this week's question. Does the insurance company take my cash value when I die? No. That is absolutely fantastic. This is like one of those things I see come up over and over and over again. And I had a client recently ask me this, by the way, and this is where this question comes from this week. Because they were a little confused about it, and they had seen something that a famous household name financial guru had said on his radio or whatever, TV program, I guess it is now, his YouTube channel. It is a most vicious lie. And it's pretty obvious to basically to every insurance agent and financial advisor who passed their life insurance exam, their state licensing exam, and or has taken any sort of like real financial planning class about insurance, or has been in the business more than, a couple of years. So just to make it clear, I want to be emphatic about this. No, the insurance company doesn't take your cash value when you die. They don't take it from your whole life policy. They don't take it from your universal life policy. They don't take your cash value at all when you die. I don't know how many people hear this, but I know enough people hear that I've gotten this question a couple of times from a couple of different places. It's a flat out lie. The death benefit, first of all, every whole life, every universal life, they all basically work the same way. Premiums get paid to the life insurance company, expenses come back out, and then whatever's left over is credited with interest. The expenses that come out go to pay for the death benefit, but the stuff that's left over becomes the cash value of the policy, and it usually ends up being a substantial amount, and it grows up over time. And the whole point of the policy is that the cash value is a reserve. It's a reserve that's set aside to pay for the future death benefit. So the death benefit is comprised of two things: cash value and pure insurance. The death benefit is often mislabeled as just the total insurance component of the policy, but this is false, because legally and contractually that's not how it works. You can ask any actuary, you can ask any product development guy, any insurance agent worth his salt. Death benefit, especially in a whole life policy and in a universal life with level death benefit, the way that it works is that you have net amount at risk, and then you have a cash value that's building up to replace that amount, because the insurance company's on the hook for what's called the net amount at risk, or pure insurance. That's the amount that you're being charged for, because that's the mortality risk that the insurance company has to cover in their contract. They don't have to cover the cash value. All they have to do is make sure that that money doesn't get lost, and they have ways to do that. And that's where the guarantees come in, and the interest credits and all this stuff. So the insurance company's job is just to make sure, protect the cash value, grow it at a rate that's going to be sufficient to replace the pure insurance. See, from the insurance company, you got to think about this. From the insurance company's perspective, they want to get rid. They're willing to take on the risk, but then they want to get rid of it. And the way they get rid of it is by making sure that the amount of pure insurance on the books is either going down over time, or they're somehow being able to sell that off to a reinsurer and get the risk away from them. But in a permanent product, that risk is constantly being decreased with every premium payment. But that narrative of, they take your cash value when you die, that it's necessary to frame it this way to pull off the non-sequitur in this argument that's about whole life insurance and UL policies being bad, garbage or whatever. In financial speak, the cash value of a whole life policy represents what's called the net present value of the future death benefit. So it's almost, in a sense, almost like a cash advance on the future death benefit. It's the current value of that death benefit. The death benefit, think of it like equity against the death benefit. So the death benefit is what the entire contract is worth when you die in the future. And the cash value is what the death benefit is worth right now. This is why both the rate of return on your death benefit and your cash value depends entirely on when you die. The volume of interest you earn in your contract grows even as the rate of return stays flat or declines a little bit in your extreme old age. I know this disappoints some folks and probably a lot of critics because they don't want it to be that way. But and maybe maybe it's disappointing to see the rate of return if you're a policyholder. Maybe it's a disappointing to see the rate of return drop when you're 90, because sometimes in some contracts it'll fluctuate and it'll kind of drop down a little bit in extreme old ages. But you just have to live with the resulting annual dividend that is 10 to 20 times the premium that you paid if you're if you're a participating whole life policyholder, because the dividend grows and to be a ridiculous amount. Plus several $1 million in let's say in guaranteed cash value, if you bought a decent sized policy, plus whatever pure life insurance is left in the policy at that age. So in age 90, it wouldn't be much. You're not actually buying a lot of insurance at 90. To the insurance company, trying to insure a 90-year-old person is going to be wickedly expensive. So they want to make sure that they're not insuring a 90-year-old or whatever insurance is left. There's not that much left. Here's yet another way to understand it. So the death benefit is like the current market value of a home, while the cash value is like the current equity of the home. So if you have a great big mortgage against the house, the equity will be low. But as you pay off the debt, the equity grows until it equals the market value of your home, ideally. I get it's not a perfect analogy because home prices fluctuate, blah, blah, blah. But, and it's technically, it's possible to be upside down on a mortgage. But I don't want people coming back at me and saying like, oh yeah, Dave, what about this? What about that? If you can get the principle, if you can't get the principle and you're going to be a reply guy, just forget it. Don't even bother. But if you can understand like the principle of it, of like how this works. So that's what I'm trying to get at. So life insurance is kind of like a more perfect form of saving in that sense. A more perfect form of that, that whole, home versus home equity analogy. So you can, in the sense that you can never be upside down in your life insurance policy. In a whole life policy, it doesn't happen unless you intentionally overloan the policy. But if you can't, in a normal sense, you can't be upside down on your life insurance. So sometimes critics will protest that when you die, the insurance company steals your cash value and only pays the death benefit. And then, they wish the insurance paid both the death benefit and the cash value. Again, no. Unless you're talking about universal life where there's an increasing death benefit, what happens there is the insurance company, you're buying insurance and the actual insurance part of it just stays level. And then the cash value gets piled on top of that. But that doesn't necessarily mean that you're better off down the road, because you're paying for that. Like if you buy $100,000 of face of universal life, of death benefit, of actual insurance, that's gonna, like, you're never really getting rid of that. So at age 90 or whatever, you're still having to pay for $100,000 worth of insurance. It gets to be really expensive, which is why people usually choose at some point, if it's increasing death benefit on a universal life, at some point people will stop doing that and then switch to a level death benefit so that they can buy down the term insurance and have more cash value. The costs of the policy go down, and so on. The overall cost of the policy go down. And the same thing in the whole life, it just automatically works that way. You're decreasing the amount of insurance you're buying. So think about it this way. So like when you're about to sell your home, imagine a seller telling you that he wants the full value of your house plus the equity in the house. I mean, like, you'd look at him like he had alligators coming out of his ears. It's crazy, because it sounds crazy, because it is crazy. The value of the home includes the equity, which is again is how whole life insurance works, how universal life insurance works. So if you look in your policy contract, you will see terms like net amount at risk. Now this is the thing, like, the people who are telling you these things about like, oh, they're stealing your cash value, but they don't actually own a permanent policy. Ask them for a contract. Say, why don't you get a sample contract? Let's read the contract, blah, blah, blah. They can't do it because they don't have it, because they're talking out, they're talking out their ass. So if you have a policy contract, you can get or you can get a sample contract, which is called a specimen. A contract specimen. Look on the policy contract. You're going to see terms like net amount at risk, cash surrender value, and then when the insurer sets up a whole life policy, it's selling you two things. First, you're selling you a decreasing pure insurance, and the older you get, the more expensive it gets to insure you, which is why it's decreasing. So the insurance company solves this problem by reducing the net amount of risk to them, which is, again, the pure life insurance in the policy. So to compensate you for this and to provide you with the original guarantees that it sold you in the contract so that they can avoid, reneging on their promises, it establishes a guaranteed increasing cash value. And that cash value must increase by an amount equal to the decrease in the pure insurance. And you can see this both in your illustration of the policy and in the policy contract. And then on top of that, in whole life and participating whole life, dividends and paid up additions, will work the same way. So it's just like that in the PUAs are paid up insurance, as opposed to multi-premium insurance. So, and then, UL works a little bit differently, but in principle, it's the same, and the mechanics are very, very similar. So anyway, I hope this helps clarify things. And if it doesn't, then listen to it again and again and again until you get it. And hopefully it sinks in. But yeah, we got to stop this nonsense of they're stealing your cash value. Like legally, it doesn't work that way. Contractually, it doesn't work that way. This is only like in the bizarro world of these life insurance critics, which I at this point I don't know if they're just trolling people, or if they're just not serious, or if they really are stupid. I'm not entirely sure. But anyway, that's the question. There's the answer, and I will. That's it for this week. I'll see you next week. Okay, that's it for this week's question. If you'd like to add your question to the list, just drop them in the comment section or send me an email. And if you want more life insurance tips and advice, just head on over to monogenics.com, monegeniix.com, and sign up for my daily email list.